Welcome to the debate. Our focus today is on, well, a really foundational question that shapes pretty much everything in global commerce and wealth distribution. What fundamentally supports the value and function of modern money? We're not really digging into the history of gold coins here, but the very basis of the modern dollar, the euro, and, other major fiat currencies. So the central question we're facing today is this. Is the monetary system primarily based on collective confidence, utility, and, let's say, widespread social convention? Or is it fundamentally a mechanism of power, debt creation, and maybe even deliberate wealth extraction engineered by central financial and governmental interests? I'll be arguing for what's generally the consensus view that money's value rests on this widespread acceptance, trust, and the functional framework of legal tender and, importantly, scarcity.
And I'll be presenting the alternative perspective that we really need to look beyond this narrative of just trust and focus instead on the mechanics of it all. Money's primary function, if you look historically and structurally, is defined by perpetual debt creation and specific control mechanisms established by powerful financial and governmental interest structures that I would argue are often intentionally shielded from public view.
Okay, so my position aligns pretty squarely with the standard economic understanding of modern fiat currency. This money is backed not by a physical commodity, like gold, obviously, but by government decree and, crucially, by mass social convention. Its intrinsic value essentially is rooted in general acceptance and trust. Now, its functionality is ensured because the government mandates its use for paying taxes, right? Which guarantees continuous demand and theoretically maintains purchasing power. When you couple that with the necessary element of a limited supply, or at least a managed supply, the system, despite, its inherent complexity, it succeeds in its primary purpose, providing a highly liquid, relatively stable medium of exchange that is just absolutely essential for modern, complex economic activity.
That's an interesting way to put it, but by framing it only through trust and utility, I think you miss the deliberate architecture underneath. The modern system wasn't just some, natural evolutionary phenomenon driven by convenience. It was shaped by power. We can trace this way back to the 1694 creation of the Bank of England, an alliance, basically, where private financiers got a monopoly on credit access in exchange for funding the state's wars. And later, much later in the U.S., the Federal Reserve System, it was designed in secrecy, literally, by the nation's most powerful bankers at Jekyll Island back in 1910, and it was expressly set up to manage currency and credit to their advantage, under the guise of public stability. This intention, I argue, persists today.
I mean, look at the numbers. Around 97% of the money in circulation today is created not by governments but by commercial banks as interest-bearing debt whenever they issue loans. So this means money is fundamentally a tool for, dependence and private profit. That makes it far from some neutral, benevolent medium of exchange supported merely by a simple collective confidence.
Okay, let's address that 97% figure head on, because I think that's where the core tension really lies. You frame credit creation as purely extractive. But, if we didn't allow commercial banks to create credit, where would the capital for investment come from? For mortgages, for business expansion, for, innovation? Credit creation isn't simply a burden. It is the fundamental dynamic engine of the modern economy. It allows for investment and growth that would be, frankly, entirely impossible under a fixed commodity-backed monetary supply.
I agree that credit fuels growth. Of course it does. But we have to be honest about the mechanics of how that fuel is injected into the system. Money is created as debt, forcing perpetual borrowing. This structure inherently guarantees profit for private commercial banks through interest income. And yes, it entrenches societal dependence. And who coordinates this whole game? The central banks. They primarily inject new money, not really for the common good in the first instance, but to backstop those commercial banks when the system they created, this massive credit expansion, inevitably threatens to collapse.
Right, but central banks setting base interest rates and providing that critical liquidity, as we saw, vividly during the 2008 crisis or the 2020 COVID shock, those are necessary stabilizing functions. Their intervention is designed to prevent systemic collapse, which protects jobs, pensions, and maintains market functionality globally. I mean, if the financial system freezes up, the real economy suffers instantly and potentially catastrophically. So the question isn't just whether they benefit banks, it's whether that action averts a much greater catastrophe for everyone else.
See, I'm just not convinced that preventing catastrophe necessarily justifies the structural extraction that occurs sort of day in, day out. The control mechanism allows a subtle, almost continuous form of extraction that systematically prioritizes the financial sector. The reality is, when commercial banks and large investors make reckless bets, the risk is immediately socialized. We saw this crystal clear in 2008. Financial institutions received, hundreds of billions in public dollars via bailouts, yet the average American was largely left to suffer the consequences. Massive home losses, unemployment. And the policies that followed, like the huge liquidity flood in 2020, actively propped up asset prices, benefiting those who already owned stocks and real estate, even as millions of small businesses were struggling or failing. The system protects its architects. It illustrates for me that the primary function is often profit preservation for the few, not just neutral stabilization for all.
I do see the structural critique regarding bailouts. That's a fair point. But we can't just ignore the counterfactual. Without that intervention, the global depression could easily have dwarfed 2008. The complexity, it often requires multiple perspectives to fully appreciate it. Managing that kind of systemic risk is inherently messy, and yes, it will always create winners and losers. However, to say the intention is extraction rather than stabilizing the functional system, that feels perhaps overly cynical.
But the outcomes are entirely predictable, aren't they? And this predictability brings us neatly to our second contention, the policy tool of inflation. If the system is fundamentally based on debt, well, debt has to be serviced. And for large debtors, especially the government, which is always the largest debtor, it's actually quite beneficial to have the real value of what they owe erode over time. So I would argue inflation is not some unfortunate accident. It is a deliberate policy tool that primarily benefits the state.
That's a powerful assertion. Why specifically target inflation, in your view?
Because it is, quite simply, the easiest form of hidden taxation. As Milton Friedman famously put it, inflation is taxation without representation. It acts as a silent levy on anyone holding cash or fixed income. The state can fund its expenditures partially by simply creating new money or enabling its creation, which then reduces the purchasing power of the money people already hold. It effectively forces them to pay for government spending without ever having to announce, a tax rate hike.
That's a compelling argument, definitely. But have you considered that moderate inflation targets are also seen as necessary for ensuring economic stability and, crucially, avoiding the dangers of deflation? Deflation, that persistent drop in prices, is arguably far more destructive than moderate inflation. It discourages all spending and investment because everyone expects things to be cheaper tomorrow. So targeting, say, 2% inflation is primarily framed as proactive economic management to ensure liquidity, keep markets moving, and prevent people from just hoarding cash under the mattress. So while, yes, it does benefit debtors, the primary stated intention is stability, not malice.
The problem, though, is that the structural outcomes are not just unfortunate side effects. They are highly predictable mechanisms of wealth transfer. And here, we absolutely must discuss the Cantillon effect. When new money is injected into the economy, who gets it first?
Well, typically the banks and primary dealers, often through open market operations conducted by the central bank.
Exactly. So the first recipients, the banks, the government itself, large institutional investors, they get to spend or invest that new money before general prices rise significantly. They gain a temporary but real increase in purchasing power. Conversely, those who receive the money much later or not at all directly, like fixed income retirees, wage earners, small savers, they suffer the full brunt of the resulting higher prices without that initial benefit. This process actively and, I'd say structurally, transfers wealth away from the working class and towards asset holders, It happens again and again.
I would concede that the Cantillon effect is a real phenomenon. Yes, and policymakers certainly have to contend with it. And it absolutely contributes to wealth inequality, no question. But the goal of monetary policy, in theory at least, is to stimulate investment and activity across the board. The idea is to get liquidity flowing somewhere in the system to kickstart the broader economy. It's admittedly an imperfect tool for managing a massive, incredibly complex system.
But we have pretty clear evidence of the long-term outcome of this imperfect system. Since the Federal Reserve was founded back in 1913, the U.S. dollar has lost something like 98% of its purchasing power. This persistent, systemic wealth transfer looks like an intrinsic, almost designed feature of a debt-based fiat system. It effectively monetizes government debt and simultaneously ensures the continuous structural erosion of people's savings.
I think we agree that the outcome over a century is, yes, a staggering loss of purchasing power. That's undeniable. But that period also correlates with periods of absolutely unprecedented economic growth and technological advancement, things that arguably wouldn't have been possible without a flexible, adaptable currency supply.
Flexibility, or deliberate manipulation, which brings us to my final point. This whole power structure is maintained through a concerning lack of transparency and, frankly, deliberate narrative control.
And you're pointing to the kind of jargon we hear constantly from financial institutions and central banks?
Precisely. Phrases like quantitative easing or balance sheet normalization or liquidity provision. These aren't just neutral technical terms. They often function as shields. They obscure the reality that authorities are actively making choices, choosing winners and losers, sometimes transferring trillions of dollars, while cloaking those very significant choices in impenetrable financial language that most people understandably don't follow.
Okay, I understand the skepticism towards the jargon. I do. But complexity often does require specialized language, and financial markets are incredibly complex ecosystems. Central banks, they must coordinate closely with Treasury officials or finance ministries to manage national debt and economic strategy effectively, especially during a major crisis. If these crucial decisions were subject to constant, short-term political interference or public referendum, the policy could become erratic, unstable, leading potentially to much worse economic outcomes for everyone.
But this narrative of central bank independence is, in my view, largely a convenient fiction. It shields these powerful institutions from direct democratic oversight, allowing them to operate almost as an unelected fourth branch of government. You mentioned the need for insulation. Okay, but look at 2020 again. The Fed effectively doubled its balance sheet in a very short time, buying up massive quantities of assets. That wasn't just, stabilizing the financial plumbing. It was a massive fiscal choice, a fundamental decision about where capital should flow in society, made without any direct democratic accountability whatsoever.
But that unprecedented policy decision, you have to remember the context. It was aimed directly at preventing a broader societal collapse and a potentially severe deflationary spiral, which was seen as a genuine, imminent risk at the time. While yes, those actions disproportionately benefited asset holders in the short term, the argued alternative was a complete collapse of credit markets, which truly would have impacted everyone, likely far more severely. You need speed and, yes, some insulation to act effectively in a crisis of that magnitude.
That argument always hinges on the belief that the insiders, the experts, know best. But the secrecy, the complexity, the creation of certain economic myths, like the persistence of the barter myth in basic economics textbooks, the idea that money just arose naturally for convenience, rather than often being imposed by rulers to collect taxes, all of this serves, I think, to keep the public somewhat passive, maybe even confused. This language manipulation helps ensure the stability of the status quo and guarantees an ongoing advantage for the elites, ensuring that policy decisions that profoundly affect everyone are made by a tiny circle of insiders who operate with, really, minimal genuine accountability.
So this debate really illustrates that while money's historical origins are undeniably tangled up in structures of power and alliances between government and financiers, its day-to-day function and stability do depend heavily on the collective trust of billions of users and the functional framework provided by legal tender laws. The central banking framework, despite, yes, its clear imperfections and the concentration of power it entails, arguably ensures a degree of systemic stability and manages the inherent risks of a pure fiat system, which ultimately allows global commerce to, well, to proceed.
I still contend that we must move past the idea that this system is merely functional or neutrally serving stability. We have to acknowledge that the system's core design seems to ensure constant concentration of power and wealth. It consistently rewards asset ownership and early access to new credit, largely via the Cantillon effect we discussed. The history, the debt creation mechanism itself, and the reliance on jargon and, frankly, secrecy, it all points to money being fundamentally a tool of control, a tool maintained through dependence and continual inflation, which means it continually requires challenging and questioning, especially if we want to understand why wealth inequality seems so structurally predictable in our societies.
Clearly, understanding money requires looking beyond just the consensus view of mere utility. It means fully examining the sophisticated, often opaque mechanisms of power that shape our entire financial reality.
Indeed. And there is certainly much more to explore in the material regarding this fundamental tension, the tension between the need for economic stability on one hand and the structural implications of financial control on the other.